It's exactly the same time frame that I recorded, and the only thing I changed down here was the notations as to what they actually are. I was basically just recording price action and what my thoughts were about it, where the actual buys would occur. Starting over here, we have a sell side liquidity pool, a low formed, rallies up, price drops down, clears the sell side liquidity. Our eye goes right to this area here. That's going to be our bullish breaker. Price trades down to it here. Bullish breaker is activated, rallies. Then here is the inefficiency. Okay, right in here is the inefficiency that I said last night in the recording. This is what I'm talking about when I say your model should be concise enough and understood well enough that you could write it on the back of a business card. If you listen to what I just basically said in my commentary on $CAD, you can write all of that on the back of a business card. Now, if you hand that business card to someone that's uninitiated, they're going to be clueless as to what it means and what you're supposed to do with it. But because you're initiated, you understand my concepts, you understand what I mean when I say you're going to be looking for an inefficiency to buy into. That inefficiency is right here. I mentioned that it would have to happen during a kill zone. Okay. And we're just going to put the parameters as such. Very simple, run-of-the-mill New York Open session. All right, so here we have the inefficiency formed during New York. Once this forms, okay, we have a buy side imbalance, sell side inefficiency. Inside of the New York Open, we have the buy side imbalance, sell side inefficiency. In other words, all of this sudden price movement creates porous price action in here. There's going to be pockets where there was not an efficient delivery or offering for all of the potential prices in here that could be sold at. So as price rallies up like this, price skipped up several, basically price levels. And the way the market, or IPTA, the interbank price delivery algorithm, will want to rebalance that is it'll come down and fill in all of this. Okay, so that's the essence of what makes a liquidity void a void on liquidity. It's not that there was an absence of any trading there. It just means that there was such an imbalance or rush to move higher that it needs to come back down and offer sell side. So I give the analogy all the time, delivering paint to a wall if you're painting your home or something like that. If you have paint and you apply it on the upstroke here, initially it's a real good, nice, rich delivery of paint. As you go further up, it starts to get spotty. Then when you want to come back down, you're going to go back in here and offer the sell side. So in other words, it goes up and everything's got to come back down. So between two price points, and I don't care what price point it is, a balanced price range would be price has passed both up and down between it. Okay, that's the nature of IPTA. That's all IPTA does. All it does is simply looks to rebalance previous moves and run to outside of the present range to either engineer or neutralize liquidity above and below old turning points. It doesn't see your stop. It does not know what your stop is. It just knows that above those reference points, there's going to be liquidity there because that's how everyone's been trained to do so. And the industry still promotes that idea. Support resistance, double tops, double bottoms, all that stuff. We take that and we turn it on its head. So I mentioned that the signal and the formation that you would be studying for $CAD today was going to be in the form of an inefficiency today during New York. We see that occur here. Price trades down, hits an order block right in here. That's what I mentioned on the Twitter recording from a free members or students perspective. That's what's being shown here, the order block. And then price rallies away, closes in this sell side imbalance, buy side inefficiency, meaning quick sudden movement down, there's an absence of buy side. The market's going to want to rebalance that. The initial buy off the order block here runs up and hits this right there. Now, if you looked at this entire movement right here, that is a price action model. That could be your price action model. I'm not stating that it should be. I'm just emphasizing that that's how simple a model creation is. If you can see this formation here, that is your model. Now, you wait for these to form on whatever time frame you like to trade. It could be a 15-minute time frame. It could be an hourly setup. It could be a 4-hour trade if it's a swing trade idea. If you want to be a position trader, you can do it on a daily chart. Long-term investing, it can be done on a weekly chart. It's completely limited by your personal thresholds for tolerance and sitting in trades. I don't have that much patience. It may seem like I have a lot of patience, but I don't. So I like to day trade, scalp, not so much, but short-term trade, love it. And I like to look for my setups on an hourly and 4-hour basis. So it gives me my really nice turning points, and it gives me my objectives for the week's highs and lows, what to look for, all those types of things. But for day trading and scalping and practicing, you can do so many exercises each day with several pairs by either hindsight study or watching price action live. If you do not have the ability to watch it live, the best thing you can do is invest in, I mentioned this, one of the members of my Twitter following asked,